Let me show you why profitable businesses still get hit with tax penalties even when they're making quarterly payments. This is one of the most common and frustrating tax surprises I see from my clients. Here's what most business owners do. They'll take last year's tax bill and divide it by 4. Now, if the business grows, that method is actually going to fall behind and cause them trouble. You see, in this example here, the business paid $80,000 during the year for their taxes based on that method. However, the actual tax they owed was $140,000 because their business grew and they didn't plan for it. That gap creates a $60,000 balance due plus penalties on top of that, okay? Even if you grew better than expected, okay? And you still made your tax payments same as you did last year, you're still going to get penalized because you should have paid more. Okay? Now, you didn't do anything reckless as a business owner. You just didn't plan forward. And you have to plan forward, especially when it comes to taxes. The IRS is not forgiving. Okay? Now let's talk about the safe harbor method. Maybe you've heard about it, okay? It's widely misunderstood. Here's the rule, the safe harbor method that the IRS allows you to do, okay? If you pay 100% or 110% of last year's tax, you avoid penalties even if the business grew, okay? But look at what still happens. You owe zero penalties, but you still owe $50,000 at filing, okay? That's a problem for a cash flow perspective. You don't want to have a huge surprise tax bill and have to dump all this cash out because it will throw off your whole year and all your planning, okay? Safe harbor method protects you from tax penalties, but it doesn't protect you from the tax that you actually owe, okay? So what do you have to do? You have to work with your CPA on an ongoing basis. That's basically what this means, okay? This is called tax planning, okay? You estimate the current year based on actual performance and you adjust as the year unfolds, right? So if you're doing better than expected, okay, you need to assess that every quarter and then up your tax payments. That's why it's critical you work with your CPA. You obviously don't want to overpay, so your CPA should be reviewing your books every quarter to make sure that you're not paying more than you need to in taxes, but also you're not paying too little or else you're going to get hit with penalties. It's always a moving target, okay? Quarterly taxes aren't about guessing or avoiding penalties. That's not the goal here. It's about aligning payments with realities. There's no trick or avoidance technique that any CPA could tell you to do, okay? Now, this is a very simplified example, but I see this all too often. Filing your taxes backwards looking, okay, is a big problem. You need to be thinking forward. So ask your CPA what they're doing to make sure that you are in compliance because it's you that's on the line. It's you as the owner that's going to owe the money, not the CPA. Okay? Make sure you're reviewing this quarterly. And if you have any questions, reach out to me.